Get ready to dive into the intriguing world of private equity. In our 4-part interview series with Michel Degosciu from LPX, we unravel the secrets of an exclusive financial realm and explore the revolutionary concept of listed public private equity. Welcome to the 4th part of our interview series on listed private equity, where we are going to explore the risks associated with private equity. Welcome, Michel Degosciu.
Hello, welcome.
So, Michel, what returns can investors expect when they invest in private equity?
But of course, it depends on, first of all, on the time frame that you're analyzing, and then also on the type and style of private equity investment. When we look at the total private equity market over the past, let's say, 10 years, you had a return of around 10% per year. When you look at the underlying fundamental performance of private equity, that's what you can expect from the, let's say, fundamental performance, economic performance of private equity. When you look at the stock price of those private equity companies over the past 10 years, then the annualized return was around 15 to 16% per year. So basically it means you have a return of around 10% per year, plus then the uplift of the private equity companies that are listed on the stock exchange and are trying to make good investments, trying to always find the best manager, the best investment into a particular sector, and then are getting an uplift to the NAV, because that's what we regularly see in the portfolio. When you look at the exit valuation, you always have an uplift compared to the NAV. So the NAV performance is a little bit underestimating the performance of private equity because of the fact that they're usually getting a much higher valuation when they sell something. This explains also why the stock price is then returning a little bit better than the actual underlying NAV performance of those companies.
But as all investors should know, a higher yield return also comes with risks. So what are the main risks by investing in private equity? Well,
there are several risks. I mean, first of all, you have to be aware that private equity is correlated with traditional stock markets. I still hear the argument that private equity is uncorrelated, but this is mainly due to missing data. But when you look at the underlying business model, it doesn't make sense that it should be uncorrelated. Of course, it is correlated, because when the stock price in general goes up, then it's easier to have an IPO, then the valuation multiples are higher. It's much more easier to get a deal done when everybody is investing into risky assets, and this includes private equity. So you should be aware and not be irritated when someone tells you it's uncorrelated, it's correlated. So be aware of that. So that's certainly one risk. You have to be aware of that. And then, of course, only invest that type of money, of your personal wealth, that you don't need in the next coming years for whatever reason.
And what means in the next coming years? So what is the usual time horizon that investors should have?
Well, I always say at least 5 years. When you invest in private equity, at least 5 years. The advantage with listed private equity is that you can sell it at any time. Whenever you want, you can sell it. However, as I mentioned, there are some risks associated, so I recommend at least 5 years, and only that part of your personal wealth that you don't need into those.
Okay, this sounds
years.
Reasonable. And how does private equity perform in times of crisis?
Well, this depends a little bit also on the investment style. So as I mentioned at the beginning, you have to differentiate between various investment styles. First of all, between venture capital and buyout. Buyout is a little bit more stable because the investments are done in mature companies that already have a proven business model, where the private equity company buys the majority of that company. Whereas venture capital are startups, new companies, where, of course, by nature of business, there are more risks associated to venture capital. So this is a little bit or is something that investors should be aware of. And then the second very important point is the type of leverage or the degree of leverage. Makes a huge difference whether a private equity company invests with a high degree of leverage or with a low degree of leverage. And of course, in times of crisis, companies with very high leverage tend to be much more riskier than companies which have cash at hand and can invest into times of crisis, because you usually should invest when valuations are low. Also from the perspective of the private equity manager. But this is, on the one hand side, is a risk. On the other side, it's one of the advantages of private equity, because a private equity manager can profit from both types, from an increasing stock market, because then he can sell over the stock exchange, can expect high returns. On the other side, when stock markets are going down, when we have a recession, then he can make very good investments at low valuations. So the very good private equity managers are able to manage those both cycles. But then an investor should be aware, and when he makes a single investment in a single company, should analyze how do they react in times of crisis and how do they manage times of crisis.
And there is usually more leverage applied in buyout or venture capital?
To be honest, this depends a little bit. Typically more in the buyout sector, because then you have already a proven business model. You can more easily get leverage also on the company level. On the other side, in venture capital, it's not that easy to get financing from a bank, for example, to finance a venture capital deal. In the buyout sector, that's much more likely. So I would not say buyout or venture is more levered or not. It really then depends on the actual deal. So even with leverage, a deal can be very successful and very attractive as compared with no leverage. It really depends on the actual deal level. But typically in buyout, it's much easier to get a financing compared to venture capital.
And what are the current trends in the market?
Well, until last year or beginning of last year, we saw a huge trend in venture capital, in IT, in software. We saw very strong growth there. This has decreased a little bit over the past 12 months, to be honest. We have seen a huge uplift in private debt. For several reasons. First of all, even after the financial crisis, 2009, new financing facilities emerged from companies that are non-banks. So non-banking facilities, non-banking financing increased dramatically after the financial crisis, and also over the last couple of years. This has again increased, and this is a trend that we still see, and I think this will continue also. What we have seen now in the US with the banking crisis there, I think the trend to non-banks providing financing to medium-sized companies will be a very important investment part in the next coming years.
Yeah, but we can say the risk-adjusted returns in private equity are still making it a very interesting asset class.
Yeah, when you include private equity into a global portfolio of stocks and bonds, you can increase your risk-return profile. Yeah, definitely.
Excellent. Thank you very much, Michel, for sharing your insights. Thanks for joining our interview series on public listed private equity.